got that G, got my nullos. I'm just saying. We pull up to the scene, they be filled with jealousy. If a bitch get
stop
finicky, she gon' bring the energy. I hit a phone with a
3, 2, 1, action.
Dear light.
So hello guys, I'm back for another video and I hope you guys are having a good time. Welcome to my channel. Option trading, honey. I'm so happy that I now know another form of making income as an investor and a stock trader, okay? And this feels so good, just knowing that you have more options rather than just staring at your portfolio, just looking at it and it's looking at you and you're looking at all the craziness going on in the world today. So let's get into this. So when it comes to this, it's called the buy right option strategy. By now we know what option trading is all about, right? You may not have the securities personally, but you're able to trade stocks. But you should make sure you are registered with a brokerage account or a broker in order to trade options, okay? And they come in two forms: puts and calls. You pick up the call and you put down the phone, okay? So when the market is going up, you're going for calls, and when the market is going down, you're putting down the phone. Never forget that.
I'm back, I'm better.
So it's called a buy right option strategy. There are so many strategies and we'll get through them when I start doing the practical part of it, okay? So this is when an investor sells a call option while simultaneously buying the underlying stock. Now, I have seen this strategy and it's interesting. That means you're using one stone to kill two birds, okay? You're using one objective, you're using one opportunity or one objective to get two opportunities, okay? So you're selling the call option while simultaneously buying the stock itself, okay? Now, this strategy is similar to covered calls, except that both the stock and the call option are entered at the same time. The investors with an investment objective of income utilizes a buy right option strategy to collect premiums from the sale of call options.
We're gonna get into some technicalities here because they always gotta come with the receipt.
A buy right option strategy requires a moderate level of risk tolerance. I have seen this strategy. It makes a perfect sense. But what you should know is that with this, you have to have stocks, honey. So the maximum potential loss is the entire value of the stock less the premium received from the option sale. Yeah, this is when you're buying an option with the intention of buying the stock, okay? So you really want that strike price to go through. Okay, this is because the buy right has a limited upside profit potential during the duration of the option. So this is because the option seller has the obligation to sell the stock to the buyer, or the option exercises the option. You see, so whether you like it or not, if you don't sell as a seller, I feel like, nope, I'm holding on to my stock, no bitch, it will exercise on its own. I have seen this option. Therefore, an investor who seeks to buy a buy right strategy may have their shares sold. See what I was saying? At a strike price, and may no longer participate in future stock price increase. I have seen this option. This option is so if you sell this option, so this is where you're going with the intention like, oh my god, I'm hoping. You're slightly bullish when it comes to this option. See, the investor has a neutral to slightly bullish outlook.
I got chills, then multiply.
That does not anticipate that the stock will go, exceed beyond a certain point. So you just want it to keep going like this. If it goes too well, you're fucked. If it goes, so you're looking for stability when you go for this option strategy, okay? Now, for example, an investor anticipates that a stock A will go up in a short term but not beyond a certain price. Okay, so the person, not he, they simultaneously purchase 100 shares of that stock at $9 in addition to selling a call option of that stock at $13 strike price with 2 months until the expiration for a premium. So they will get a premium, but they also have the intention of selling a call option while purchasing at a lower price. So long 100 shares bought at $9 of the stock, sells one call option with a $13 strike price. So if it gets to $13, sold, and you still get a premium for this. So the maximum profit per option is the difference between the strike price and the purchase price of the stock. So it's between the strike price of the option but the purchase price of the stock plus the premium collected from the option sale multiplied by 100. So maximum profit per option would be the strike price of the option minus the stock price plus the premium. So if the stock price is $9 and the premium is $1, but the call option is $13, so it will be $13 minus 9 plus 1. So that should be 13 minus 9 should give me $4 plus 1. Okay, so 13 minus 9 will give me $4 plus 1 will give me $5. So it will be 500 because it's 5 times 100. Remember, 100 shares for each contract. So if you say 10 contracts, that is 10 times 100, honey, 1,000 shares. So remember that, because you don't want to make that mistake, because if it goes through, you are forced to pay all of that if you don't have the money. Okay, so the maximum loss is the stock purchase value less the premium received multiplied by 100. Okay, the break-even point is the stock price less the premium multiplied by 100, and the maximum loss per option would be the stock price minus the premium. That will be 800. The break-even point would be the stock price less the premium, because nothing went through, okay, multiplied by 100. So that will be the break price. So the profit loss, let's see the chart. Good. With this chart, it shows if it keeps going down in price for the stock, you lose money. But if it keeps going up, fixed rate is there.
Wait a minute, who am I? That's a Raven moment.
Because even if the stock is at $100, you've gotten your profit out. So you're not looking forward to any future growth of that company. You've gotten your profit, you've bounced. And the person who bought it from you now owns the stock. So they, after the expiration date of your contract, if the stock increases, they make profit from it. But you who sold with the buy right strategy, any future growth after the expiration, the stock is no longer yours. So you've already gotten your profit and said, okay, I'm out of here. But the person who now has the stock keeps it, and if they want to sell it, they sell. If they want to keep it, boom. Okay, so this chart shows the potential loss. So if stock A trades up $13 and beyond, the investor who will make 500, which is made up of 400 from the stock price appreciation plus $100 from the sale of the call option. Conversely, the maximum potential downside is this person who bought this strategy or this option from the seller would lose all 800 if the stock keeps going down. So if the stock goes down after the strike price, if the stock goes down, the buyer incurs the wrath of it, while the seller has already bounced, kept their premium, kept and walked away. Okay, but if the stock now rebounds and goes up, you, the buyer, keeps all the profits, all the growth, but the seller, okay?
Look at us. Look at us. Huh? Who would have thought? Not me.
Yeah. So this is comprised. So this is comprised of $900 loss, because remember that premium. So if the stock goes to zero, the premium, the seller keeps that, right? At any point, if the stock trades above, the investor, they will be obligated to sell the 100 shares, because now they are not assigned with these shares, right? Because they bought this option. Because so it's like using one objective to get what? 2 opportunities. Then the investor would make, like I said, the investor will make greater gain than he had not sold the call, while still able to retain the shares. So the person who will be losing if the stock goes to $1,000 a share, the person who will benefit from that would be the person who bought this strategy or option. The person who sold has already taken their $300 and gone, so they no longer have any rights to these shares. Okay, now the same holds true if the stock falls between $8 and $0. The premium received from the sale of the call option helps offset the losses of the stock by 100 had he not sold the call option. So it's either this person is like, okay, I want to get rid of this stuff if the worst comes to the worst, so let me just get this profit and move on. The person who bought it is the one that is standing a greater chance of all risk, because it's either the stock goes to zero or the stock later rebounds and becomes something big and they make money. But in this instance right here and now, when this contract is drawn, the person who will make profit instantly and get a premium is the person who sold this option. The person who buys is the one who is now stuck with it if this goes through. Okay, so this is why they say in the money and out the money, honey. So this person wants it to be wants that strike price so they can now get the shares to themselves in a way. You know, they really want the shares, they really want the company, that's why they're going for this option. But the person selling it is not really crazy about any future growth with this company. So like I said, they have a neutral, you know, sense when it comes to this, that it's like a, see, an investor who has a neutral to slightly bullish outlook on the stock that will go for this kind of option. Okay, so I love this. I love the breaking down of this stuff. Anyway, I cannot wait to see you guys soon in the next video. Please let me know if you had an idea or if you understood what I just said. Okay, so when you have a neutral to slightly bullish outlook on a stock, you're like, okay, I'm going for a buy-right strategy. I have my strike price at 500. Okay, I'll get my instant premium, hold on to that. Now if the stock gets to that, I'll give it away. Now I've already taken my upfront profit, which is limited, like 200. Boom, I've moved on.
This ain't no allegedly.
This person, right, that's the maximum profit I, who sold it, would get, right? Now this person who bought this contract from me in the buy-right strategy option now holds the rest of the risk to the stock. It's either they'll hold on to the stock or sell it after the contract. If it goes beyond, they can sell it, but they can sell it at a higher price and make money. Else, if this stock goes down to zero, the buyer would lose everything. Okay, simplest way to put this. So this comes with call price, comes with call option price, stock price, and premium, honey. Strategies, honey. So anyway, I'll see you guys soon in the next video, and let me know in all these strategies and option strategies, which do you prefer? I prefer buying puts for stocks that, you know, because I have the stocks myself, so I have the stocks, the shares, so I prefer buying puts, long puts, and selling short calls. Okay, like but my fingers are like, please don't get to this strike option, you know, option, so I don't have to lose my stock, because I'm trying to offset my, you know, losses. Look at my portfolio because of the market. Look at how my stuff has gone down, so I'm trying to, you know, offset it, because you don't lose that unrealized losses until you sell the stock. I have sold about $2,500 worth of losses for the year, because I can only claim up to $3,000. So any options profit I make would offset that loss that I've sold, okay? As strategy. So that's my strategy. I buy long puts, and I buy long calls, and I sell short puts, okay? Short covered calls. So that's it. Sometimes I don't mind selling, you know, short puts, but you have to be very careful with that strategy, okay? I'll see you guys soon in the next video, but there are strategies where we call them the struggle. This struggle, I'll show you guys the example. Struggle, if the price falls within a certain point, you make money or lose money. Then if it gets to a certain point, you make money, but within there, so let's say from $1 to $2, if the price falls there, no money. But from $1 to $0, I'll lose money. Then from I'll make money also. Then from $2 to $3 and above, I'll make money. So there is this, it's called the struggle. There are different shapes: struggle, W, V. I got you guys. I'll see you guys in the next video. For some video, and I said that I'm so happy because this is educational. Okay, I'll see you guys in the next video. And just go out there and trade and be safe. Okay, the next videos coming out would be practical. You see me on my phone actually making trades and explaining, so you can see what we've all discussed about. And until next time, bye guys.
Yes. We've had a little incident. Can you send an ambulance to 4352 Seneca?
Cause I'm loving myself real good.
Did you guys hear that? I'm scared.
In a way that you never could.